Hi, I'm Steve LaFrance, and welcome to our March update. The S&P declined 0.8% in February, but that masked broader strength. The equal-weighted S&P gained 3.5%. Large cap value rose 2.6%, and the Russell 2000 added 0.8%, as leadership broadened beyond the mega cap tech. Large cap growth and the NASDAQ both lagged down 3.4% and 3.3% respectively. So what moved the markets? Breadth and rotation. Investors shifted into value, cyclicals, and defensives after a long stretch of mega cap concentration. Early month volatility in tech reflected reassessments of which companies benefit most from AI. That selling eased as the narrative shifted towards AI as an augmenting tool. The 10-year Treasury fell below 4%, supporting bond returns and lifting gold as investors sought protection. The Supreme Court's tariff ruling reopened trade policy uncertainty. The U.S.-Iranian conflict triggered obvious geopolitical concerns, and a late February PPI surprise added an inflation wrinkle. On the earnings front, companies broadly beat expectations, which helps explain why valuations look more attractive in places even as the market grinds. The top sectors were utilities, plus 10.3%, energy up 9.4%, and materials up 8.4%. International markets and emerging markets both continued their strong runs with another 4.6% and 5.5% respectively. Payrolls rebounded in January and unemployment eased to 4.3%, while the PPI jump late in the month complicates the inflation outlook and keeps the Fed cautious. While the market still expects the Fed to cut rates twice this year, the start date keeps drifting later. What does this mean for portfolios? We've said this before and we'll continue saying it. Diversification matters. The rotation reinforces the value of exposure to value, smaller companies, international equities, and quality fixed income. AI is a durable theme, but adoption and monetization timelines vary. Tariff uncertainty and geopolitical risk can create episodic volatility. So let's focus on what you can control. It can be nerve-wracking to concede that, individually speaking, we don't have any control over what happens at the global level. Obsessing over the news won't change what happens. Timing the market won't help. The urge to trade rises with every headline. History shows that reacting to noise typically reduces long-term returns, and doing nothing is an honorable and disciplined decision. This chart illustrates the history of the S&P 500 1 year after major geopolitical events. If your circumstances, risk profile, and time horizon haven't changed, then continue your regular retirement contributions, maintain your asset allocation, and let the plan work. Bottom line, February was a month of rotation and recalibration. The headline S&P decline hit a broader advance across the average stock. With earnings holding up and valuations improving in parts of the market, disciplined diversification, measured exposure to rotation leaders, and a steady savings cadence remain the most sensible path. As always, our team will continue to closely monitor incoming economic data and evolving market trends to help make sense of how the markets are performing. Thanks again for your trust and confidence.